Good morning. Welcome to Stock Market Today. It's Monday, March 16th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So U.S. equities were higher in Friday's trading, ending near the best levels of the session following a big rally in the final minutes of trading. Despite that rally, the index still closed down more than 8.5% on the week. On the day on Friday, all sectors were higher, with financials and technology leading. Utilities, discretionary, and materials were a relative underperformer. Treasuries were weaker, with the curve steepening. Dollar was up on the major crosses. Gold was down about 4.5%, and WTI crude closed up about 70 basis points, but saw its worst week of decline since December 2008. But a starkly different picture here as we get to the desk this morning. S&P futures have been trading down, limit down, pretty much since they opened last night, despite a 100 basis point emergency rate cut by the Fed and a pledge to buy bonds. That's on the heels of that rally. Asian markets were lower overnight. Australia posted the biggest decline on record, while Hong Kong, Taiwan, and mainland China all sold off as well. European markets are under pressure. Treasuries are rallying with the curve steepening. The dollar is weaker on the major crosses, in particular the yen. Gold is up 20 basis points, and WTI crude is down about 5.5%. to get us going on a Monday morning. So futures trade limit down despite that 100 basis point cut as we look at the structure of the S&P 500. While the futures are locked limit down, SPY is trading, and at last check was down about 9%. I think the 2018 lows are in play around the 2330 to 2350 level. If that level were to break, we have to start thinking about 2100, which is the breakout from the 2015-2016 consolidation. Should we get a rally here in the near term, resistance begins near 2800. The RSI is holding in bearish ranges, confirming the strength of the near-term downtrend that we have seen in prices. If you'll notice now, the 50-day moving average and the 200-day moving average both beginning to move lower. Chaikin money flow is neutral with a bearish bias as it's dipped into negative territory here. So folks, we're in a bear market. There's no two ways about it. There is potential for us to see some sharp rallies in the interim, but generally speaking, if we look back historically through bear markets, the initial low is usually tested. And as we've been saying, we'd be looking for less selling pressure, less intensity on any retest of the initial lows to give us a sign that a base is forming. Not really seeing any signs of that just yet. So we're going to have to give it some time to play out. In the interim, we're going to try to highlight the key levels where the market could potentially look to form a base. Turning now to our market in a minute, what are we writing about in the note today to Chaikin Analytics clients? Well, futures trade limit down in the overnight session as the Fed cuts rates 100 basis points and increases bond purchases. And that was happening just as the 10-year Treasury was testing support at a key breakout level, that being the IEF. We'll take a look at the chart of rates a little bit later on in the show. Foreign markets, as I said, are trading sharply lower on Monday despite coordinated central bank easings around the globe. So, central banks are doing all that they can. I think the question on the part of investors is it really enough to combat what is essentially, it's a healthcare concern at its very basic tenet. So turning to our major indices from a power bar perspective, you can see that big rally on Friday with all the major averages, save for the small caps, up over 9%. The Dow added 9.3%, 0 bulls to 5 bears there. The S&P 500 up 9%, 9 bulls for 124 bears. So the power bar ratios are squarely in bearish territory. NASDAQ, slight outperformer relative to the SPY, up 9.3%, 3 bulls to 25 bears there. Small caps, despite adding nearly 7%, we're actually a big underperformer on the day. 45 to 505 bulls to bears there. Bonds downtick, sending yields higher, but that is quickly reversed in the overnight session. Financials were a big outperformer on Friday, up 13%, but 0 bulls and 4 bears there. So according to the Chaikin Power Bar, small cap stocks and large cap stocks have become strongly bearish. Major indexes are strongly bearish from a power bar perspective. Hitting our stock of the day now. I'm actually highlighting the stock that I'm featuring in my note today. Nathan's Famous has a very bearish Chaikin power gauge rating due to very poor financial metrics and weak earnings performance. Does have some strong price volume activity with that big rally of late, helping money flow. However, when we roll up the 20 factors, 5 in each of these 4 categories, we come out with that very bearish rating for a stock that's in a weak trend and a weak industry group. We are below the declining long-term trend line. Now, what we see here is a very bearish stock continuing to underperform the market despite that big rally on Friday afternoon. The stock was up 13% on Friday. Stock is overbought. Money flow is mixed to slightly bullish. Solid resistance here at the $65 level begins to come into play, and it did trigger an overbought sell signal here at Chaikin Analytics today. Likely to be down here in the pre-market. I'm kind of just highlighting it here, looking for weak names that have rallied to potentially take money off the table or even begin to look for bearish opportunities should they present themselves. Turning now to the sector tracker, the movement of the major sectors over the last 5 days. And despite that big rally on Friday, all sectors are lower over the past week of trading. Tech, healthcare, and comms, the relative outperformers on the week. Staples, REITs, fins, and discretionary are middle of the road. Materials, industrials, utilities, and energy, your big laggards on the week. You know, the materials and industrials are obviously levered to global growth. Utilities came under pressure as rates have backed up again. You know, at this point, as I said on Friday, you know, any analysis is on the relative nature. You're looking for the areas of the market that have held up the best so that when we do begin to see signs of stabilization, those are the areas where you can begin to look for bullish ideas. Now, we have not seen those signs of stabilization just yet, so it's hard to argue that it makes sense to get aggressive here on the long side of the portfolio if you're taking a short to intermediate term view. If you're a longer term investor, obviously there are going to be some good companies that get thrown out with the bathwater. It makes sense to be doing your work there. I do not see anything in energy, though, that excites me. As energy remains at the bottom of the list, it seems to have a permanent place here at the bottom of this list. And you can see there, even over the past 5 days, the market was down the market was down about 8.8% last week. Energy was down 24.25%. So massive underperformance on the part of energy continues. And our auto-generated industry in focus today comes out of that group. It's oil and gas equipment services, which over the past 6 months has underperformed the S&P 500 by nearly 58%. Its power bar ratio, which measures future potential, is very weak. 0 bulls for 16 bears there. It's currently ranked number 12 of 21 subsectors. That just tells me that there are a lot of subsectors with 0 bullish stocks. It has moved up 4 slots over the past week, but as we've been saying for some time now, nothing really to get excited about here. In particular, the indicative names there, Secor Holdings, CKH, Drillquip, DRQ, and Valaris, VAL, all with very bearish Chaikin power gauge ratings. And if we take a look at the chart of XES, the ETF that represents this group, we can see the very bearish ETF power gauge rating and the weak trend below the declining and steadily declining long-term trend line. Massively bearish money flow despite being down from $12 to under $3, still being sold off. You can see the level of underperformance have been in place for the better part of the past 12 months to go along with that very bearish rating. So there's been no reason to be looking at energy stocks from a power bar perspective, from a power gauge rating perspective, from a relative performance perspective. It's weak. It has been weak, and we don't see any signs of stabilization just yet. Turning now to what's trending. Yesterday's S&P 500 or Friday's S&P 500 movers and shakers are gainers and losers. LNC, didn't see anything company specific there to drive that stock higher by 24% on Friday. Cody up 23 1/3% as they are selling one of their business units. Nothing company specific on Ameriprise, up over 22.5%. The financials were strong, as we said on Friday. The financials as a group added 13%. Nothing company specific there. Same goes for State Street. STT adds 22%. I think you saw over the weekend, a lot of the major banks said that they are suspending their share buybacks. VTR, been one of the beaten down names. They do senior housing, has a bearish rating. It did rally 21% on Friday, but likely going to come under pressure here again today. On the loser side of the board, Newmont down with gold to the tune of 11%. ZBH, Zimmer Biomet down 4.15%. Nothing company specific there. Capri down nearly 3% following a downgrade from Deutsche Bank. HPQ down nearly 2% as they are in the midst of a deal with Xerox. And we have to start to think about what could happen to some of these announced deals, given everything that's going on with coronavirus. Finally, Lennar caught a downgrade earlier in the week from Bank of America Merrill Lynch. That stock was lower by about 1.5% on the day on Friday. Now, there are trickles of company-specific news, but at this point, the markets are trading based on everything that's going on with coronavirus. So it's hard, right? I think it makes sense to build a watch list. It makes sense to look for the names that have held up the best. But it's hard to get excited about company-specific stories at this stage of the game. So rates remain in a bearish trend. And this is interesting because we've seen a big backup in rates here to the tune of about 45 basis points in the tail end of last week. But the TNX, the 10-year yield, very much below the 50 and 200-day moving average, firmly below this broken support level, which is now likely to be resistant should we even rally back up to the 1.5% level. The RSI of the yields firmly in bearish ranges after becoming deeply oversold. Really what this is to me is an oversold bounce in yields, an overbought pullback in the products themselves from a pricing standpoint. But even as we tried to rally in the latter end of 2019, RSI never became overbought and has now gone right back into bearish territory. Rates are lower today as the Fed has actually said that they are going to increase their bond buying program. That has lent a bid to Treasury prices, sending yields lower to start us for the week. So rates likely to remain under pressure for the foreseeable future here. There have been some thoughts put out there that we could see, 0% rates in the U.S. and the Fed's benchmark rate has now been cut essentially to a range of 0 to 25 basis points following that 100 basis point emergency rate cut that was announced yesterday, which has now prompted futures in the U.S. to trade limit down. The dollar rallied to new highs. We have to see how long that's going to play out. Given where we are with rates, we're taking a look at the UUP here, the Invesco DB US dollar index bullish fund. You can see we've pretty much been in a consolidation, which ultimately has now broken topside. After being oversold, the RSI is now moving towards an overbought condition following that strong rally on Friday. But what's interesting to me and what we have to be paying attention to is the already pressured commodity space will likely come under further pressure to the extent that the dollar keeps strengthening. Global commodities are priced in dollars. So as the dollar rallies, commodities tend to come under pressure, as we've seen here. Now you have the added headwind of a global growth slowdown. So multiple headwinds for the commodity complex. We can see here at the bottom of the chart, the DBC, the commodity ETF that we're tracking, pretty much trading on or at 52-week lows as global growth fears and now a strengthening dollar are headwinds to the commodity complex. And speaking of which, even the safe haven, right? Even gold came under pressure last week. We're looking at spot gold prices here after rallying up to 1,700. They've now pulled back towards the 1,500 level where they've met support at this consolidation that was in place, as well as the rising 200-day moving average. RSI not in oversold conditions just yet, and gold is seeing a little bit of a rally here this morning. On a relative basis, we had a breakout against the S&P 500. So if we're thinking about how to allocate across asset classes, gold is an outperformer. We are now seeing a pullback, and we're going to look to see if support at that breakout level holds on this pullback here. Likely going to be the case today with the SPY trading down about 9% and gold trading higher. We're going to see this line begin to move higher once again. That's going to wrap us up for today. Folks, stay with us. Take the 14-day trial. Head over to chaikinanalytics.com/test drive. I'll be back here with you tomorrow.